Stop buying Apple at 40 times earnings. Seriously. If you're piling into the stock at all-time highs thinking it's safe, you need to understand what's coming on July 30th. Here is the counterintuitive truth that every Apple investor needs to know. Apple reports Q3 earnings on July 30th, Tim Cook's last earnings call as CEO. Wall Street expects $108.8 billion in revenue, up 15.7% year-over-year, and $1.88 EPS. But here's the catch. Apple trades at 40 times earnings. That's not a growth multiple, that's a perfection multiple. If the numbers are even slightly light, the stock could drop. The bull case, Goldman Sachs says buy with a target of $340. BofA is even more bullish at $380, expecting Apple to beat estimates. The bear case, staggered iPhone launches, services growth slowing, and a CEO transition. Let me break down everything you need to watch. I'll admit something. I watched Apple hit $334.68 and thought, this is great. I should buy more. Then I looked at the valuation. 40 times P/E. $4.8 trillion market cap. Slowing services growth. And I realized, the stock is priced for perfection. Today, I'm going to break down Apple's Q3 earnings preview. By the end, you will understand why this earnings call could go either way. Stay with me. Let's start with the expectations. Revenue, $108.8 billion. Up 15.7% year-over-year. EPS, $1.88. Up 19.8% year-over-year. Goldman Sachs, buy rating with a target of $340. Upside of roughly 12%. Bank of America, buy rating with a target of $380. Expects $109 billion revenue and $1.89 EPS, above consensus. The split launch, BofA notes a staggered launch of iPhones, Pro, Pro Max, and Fold models launching in September, while base model and Air arrive in March. This can cause some volatility in the second half of 2026. The counterintuitive truth. Apple's product launch cadence is changing. That makes Q3 comparisons less straightforward. Now let me break down what is driving the numbers. iPhone, UBS expects iPhone revenue of $53.3 billion, roughly 20% year-over-year growth. Apple gained market share during the quarter. Apple was the only major smartphone vendor not to raise prices in the quarter, helping them gain share. Services, BofA models 14% year-over-year revenue growth. App Store revenue growth slowed to 3.2% year-over-year from 9.8% in the prior quarter, but this should be offset by eCloud and licensing strength. Gross margin, BofA expects product gross margins to decline sequentially before recovering. Near-term pressure is transitory. The counterintuitive truth, Apple is gaining share because they're not raising prices. Competitors are increasing prices. Now let me talk about the valuation. Current status, Apple hit an all-time high of $334.68 on July 16. Trading at 40 times earnings. Market cap roughly $4.8 trillion. The context, Apple's revenue grew only 6% in the last fiscal year. 40 times P/E is a bit rich given that the business hasn't exactly been a growth machine historically. The report, Apple is benefiting from a rotation out of memory stocks into safety. Investors see Apple as a safe haven in a volatile market. The counterintuitive truth, Apple has been criticized for moving too slowly on AI. But that weakness has become a strength. Investors are fleeing AI infrastructure stocks and buying Apple because it's boring. Now let me talk about the elephant in the room. The transition. This is Tim Cook's last earnings call as CEO. The successor, John Ternus, takes over September 1, 2026. Why this matters? Investors will watch for any commentary about the transition. BofA says investor focus will center on Cook's departure. The question, how will Apple's AI strategy evolve under new leadership? The counterintuitive truth, Cook's last call is both a celebration and a risk. Any uncertainty around the transition could create volatility. Now let me put this in perspective. Apple is trading at all-time highs. The market is pricing in perfection. But the CEO is leaving. The product launch cadence is changing. The valuation is stretched. Something has to give. Let me leave you with the 3 secrets that connect everything we just discussed. Secret 1, the P/E trap. 40 times earnings is not a growth multiple. It's a safe haven multiple. Apple is priced for safety, not growth. If growth slows, the multiple compresses. Secret 2, the Tim Cook transition risk. Any uncertainty around leadership transition could spook the market. Cook has been the architect of Apple's stability. Ternus is unproven at the CEO level. Secret 3, the no price hike strategy. Apple didn't raise prices, competitors did. That's why Apple gained share. But it also means Apple is absorbing higher costs. So what should you actually do with this information? If you own Apple stock, watch the July 30th report. Revenue above $109 billion is bullish. EPS above $1.89 is bullish. Guidance below expectations is bearish. If you are considering buying, Goldman Sachs sees 12.8% upside to $340. BofA sees 15% plus upside to $380. But the stock is at all-time highs. Wait for earnings to confirm the thesis. If you are skeptical, 40 times P/E is demanding. If Apple misses, the downside could be significant. Wait for the post-earnings pullback if you want to buy. Here is my question for you. Do you think Apple will beat earnings and hit new highs, or is the 40 times P/E valuation too rich? Drop your answer in the comments. I read every single one. Like and subscribe if you want more analysis on the biggest earnings reports of the year. I'll see you in the next video.